Good afternoon, everyone. It's Calf here. I have a very important video lesson I'm going to share with you. I'm titled this one, Winter is Coming, and we'll get into the details of what that means and why I feel that this video lesson is so important. Tomorrow is a huge day. Tomorrow is the day that the Fed is going to announce potentially the first interest rate cut in a long time, potentially starting a new easing cycle. I'm going to talk about all that, what that means for us. Why is that a big deal? You know, you've heard all these buzzwords: interest rate cuts, yields, negative yields, bonds, this, that. And I want to break them down and explain what it means for you. So I'm going to talk about just a ton of different stuff here and give some opinions and actually state what I think will happen exactly. I'm going to give my very blunt assessment. I'm even going to throw out numbers, percentages of what I think the markets will do. Most people won't do that because if you do that, you basically set yourself up to fail because you'll never get it just right. But I'm going to do that anyways because my goal is to be as transparent as possible. So let's go ahead and dive in here. First of all, let's just talk about the markets over the last 6 months. This is the S&P 500. Unbelievable move. I mean, we're talking about it's just been unreal what the markets have been doing, okay? And, you know, from those December lows last year, we've actually bounced almost 30% in just about 5.5 months. That's a massive move, just insane move. Shout out to whoever bought the S&P 500 at 2346.58. However, in the last 7 weeks, we've also had a really incredible move, 11% move to the upside, based entirely off of the catalyst of the Fed basically solidifying the fact that they will be cutting rates come tomorrow. Okay, this has been 7 weeks in the making, this run. So again, I already mentioned very important events happening this week. Wednesday, which is tomorrow, July 31st. 2 p.m. Eastern, they're going to announce the rates. Okay, I personally am expecting a 50 BPS rate cut. He kind of slipped up a little bit last week, implying this. However, just today, and I didn't include this on this slideshow, just today he then kind of switched it up a little bit, saying we don't want to get too distant and too separate from what Europe is doing with their rates, and they did not cut rates this last cycle. So that actually adds a little question mark. It'll be kind of fun, add a little excitement to things. But my personal expectation is that we get a 50 BPS cut from the Fed on interest rates. Okay, that's big. Their markets are currently factoring a 25 BPS cut. That's kind of the expected thing. There's an 82% chance of that happening, about a 12% chance of the 50 happening. But I'm kind of leaning towards that, or maybe I'm not leaning towards that. Maybe I'm just expecting that. Okay, like kind of like a expecting the worst type thing. In terms of my strategy, it would not faze me if there was a 50 basis point cut. Okay. And then after they announce the rates, of course, at 2:30, they'll come out and give the briefing, just the usual. I want to talk real quick about what this dovish and hawkish means. We've talked so much about it. Dovish means that the Fed has a stance in favor of rate cuts. Now, what happens when rate cuts happen? Money becomes cheaper. It gets easier to borrow. People are more willing to borrow money because of the low interest rates. People buy more houses. Companies take more loans out to, invest into their businesses, things like that. Now, on the flip side, hawkish. This is a stance which is fond of rate hikes, meaning the opposite. Now, neither one of them is inherently bullish or inherently bearish. It totally depends on the situation. A dovish move can actually be bearish, and a hawkish move could actually be bullish, technically, from theoretical perspective. And we won't get too fancy here, but just in general, no, you'll hear that, oh, so-and-so's dovish, so-and-so's hawkish. Just know that's what it means. Dovish means it's a stance in favor of rate cuts. Hawkish means a stance in favor of rate hikes. Okay? So I do expect 50 basis point cut, and then I expect him to make a relatively sharp turn and go slightly more hawkish. Okay, what's up with these stupid birds, though? Why do we use the birds? I didn't know this either, actually. Okay, I have just kind of accepted it was hawkish, dovish. I thought I'd dive in a little bit more. Dovish, a universal symbol of peace, freedom, liberty. It's a little bit, more loose, kind of more free policy. And this is what dovish means. That's what it means. Rate cut. Okay. Hawkish is the opposite, a symbol of power, dominance, and control. Hawkish monetary policies aim at slowing down economic growth in order to maintain them to be a little bit healthier. There's lots of things that inflation plays a large rate in this. Inflation is not inherently a bad thing, and we'll talk about that in a second. But dovishness usually leads to higher inflation. Hawkishness leads to low inflation. So that kind of explains the birds there. So what is inflation? Well, usually this is expressed as a percentage year over year. So if people say, oh, 2% inflation, that means year over year. It doesn't mean, day by day or weekly or monthly. It's year over year. Okay. So to put it real simply, let's say that last year you bought a piece of bread for $1, and this year it's $1.05. In this case, getting rid of external factors like the quality of bread and other things like that, just being real general and vague here. In this case, that would be a 5% inflation rate. Okay. So inflation technically makes money less powerful, and you look at that and you say, that's not good. My money that I have is not as powerful. It's worth less last year than it is, or sorry, it's worth less today than it was last year, etc. But inflation can actually be a positive thing. This is the reason why. It encourages people to buy and spend their money because it's going to be worth a little bit less next year. So it's actually this healthy balance where, it helps inspire and help spark up some buying in markets and in the economy, because a healthy inflation rate is just at the right level where you don't want to be, too worried about your money and just stash it in a savings account, because then it's just going to lose value. Instead, you want to be investing it, spending money on things that have value and can potentially give you a return, et cetera, et cetera. All this will actually, give a positive effect on markets. But it is, like I said, kind of a catch-22, because inflation does have a bad side to it as well. If it's too high or too low, it totally throws things out of whack, will affect the way people want to spend and view their money. Okay, a little breakdown on inflation there. Now, there's always an inflation target rate, okay, and the central banks will come out and state what the target rate is, typically. Well, this inflation rate target is usually around 2 to 3%. They've found, historically, that that's about the sweet spot it's an area that will spur economic growth and things like that, but at the same time not just take a massive hit on the currency. So inflation's good, it has a purpose. What do we use to gauge our inflation? Well, let's talk about the consumer price index. Okay, this basically gauges the price of goods, like I mentioned in my last example, bread, or any good out there in our economy, groceries, things like that. This will measure how quickly those goods are inflating or deflating in price. Okay, so it's reported monthly. For example, on August 13th next month, they'll report, it will be July's CPI numbers. So that's why CPI is such a big deal. It helps us have an idea on where we're sitting at with inflation and things like that. Okay. All right, let's talk about GDP versus markets real quick here. Okay, let's start getting into the nitty gritty here. GDP stands for gross domestic product, and in general, it represents the growth of an economy. Okay, GDP, growth of an economy. It's real simple. Let's just keep it as simple as possible. Okay, well, while GDP is moving upwards or downwards, typically an economy will always be growing, right? A negative GDP is a massive concern, but GDP will always be growing. Say it's at 2%, 2.5%, 3%, things like that. Well, keep in mind how that affects or how that relates to inflation as well, right? If inflation's at 2% and GDP is at 2%, in a sense, again, theoretically, we can get super technical here, but in a sense, they kind of cancel each other out. But the general idea here, okay, and we're going to talk about Warren Buffett in just a second. The general idea is that there is a common theme with stock markets and GDP and the way they relate, okay? Notice each time, let me pull out my laser pen here. Here we go. Oh, sorry, I messed that up. Laser pointer, there we go. Okay, so notice each time that the S&P, or this isn't the S&P, sorry, this is the Wilshire, but just in general, this is the total market. Notice that each time the total market gets up, away, and extended away from the GDP growth, we always follow this with a meaningful correction, okay? Picks back up, we get up, away, and extended a little bit, always followed by a meaningful correction, okay? Well, look what has happened here. It's a pretty simple pattern we have here. Again, this blue line is the overall stock market, the market cap, basically, of the entire stock market. Well, look how extended we have gotten here away from the GDP growth, okay? Just real basic chart reading, real basic, first grade, find the pattern, spot the pattern, try to predict what's going to happen next. Would predict that we do get a retrace to a healthy GDP level, okay, to where it's a little bit more in balance. All right, now let's go into this a little bit more specifically, and I want to talk about something known as the Buffett Indicator. But going back to this example here, let me go back real quick. Talking about this needed correction, there's two options. Either GDP can speed up massively and go meet, the total markets. That's one option. Okay, it's a very, very unlikely option. So it takes a lot more to move GDP than it would the overall market. But the other option would be, of course, for the overall markets to pull back and slide down. And it's a little bit of a mixture too. Like in these cases, the GDP was moving upwards each time, and then stock market fell as well. It's kind of a mix of the two, but definitely more so a stock market pullback than a GDP massive move to the upside. Okay, so moving on here, let's talk about the Buffett Indicator. This is Warren Buffett. In his words, this is the single best measure of where valuations stand at any given moment. All right, and we'll talk about this in the next slide and what this means. But in general, anytime you get over the 140% ratio of of stock market cap to GDP, that's where you're getting in really extreme danger valuation levels, where things, in other words, stocks are overvalued. Okay. Well, as of today, we're up closing in on the 150% stock market cap to GDP ratio levels. Okay. And there's a very common theme that happens time in and time out every time we go over this 140% level. Okay. So let's dive in here. Again, I have the gauge up here for you to reference. Let's take a look. This is that ratio level, okay, over about the last 20 years. All right. See, this is the 1.4. Okay. I mentioned 140. That's what this is. 140%, 1.4. It's the same levels. Notice we've had something really significant happen just recently. We've moved back over the 1.4 level, and historically, let's take a look at what happens when we move over this level. Massive correction in 2000. Of course, this was related to the dot-com bust. In 2008, it didn't break the 140 level, but again, it got a little bit up and away and extended, and we had a massive correction. 2016, similar thing. We got up to a dangerous levels, a significant correction. And then just recently, you look at 2018, what happened in December. This is the December correction. Could not sustain the 1.4 level. Could not sustain that market cap to GDP ratio. And if you have questions about that, Google it. Market cap, stock market cap versus GDP ratio. You'll get even more info. Okay. And just as to be real transparent, a lot of these charts, I'll be honest, I've stolen them in a sense, and you'll see a lot of the credit given within the charts. Okay, this is from just a really nice research website that you can go in and play with charts and economic data and stuff. But I just want to be clear, I'm going to be posting charts that I myself did not create. I don't want to be claiming the ownership of them. Credit is due where to the appropriate owner. Anyways, have to be careful with stuff like that. But anyways, we're right here. We've moved over an extremely critical level, an historically unsustainable level. Okay, and our good friend Warren Buffett would go ahead and tell us that we are in extreme danger of overvaluation of the stock market as it relates to the GDP. Okay. All right, so let's take a look. Basically the same chart, just a small little spin. This is the same chart. Again, we're over the 140 level here. Look what's happened each time previously that we've gone over the 140 level. We're just at a super dangerous extended level away from GDP. Okay. All right, moving on. Let's talk about divergence and why it is such a big deal. Okay. Divergence is tied closely to what we just talked about. And that's the stock market cap getting up and away from GDP. That means it's diverging. That means one's moving up, one's moving really fast away from the other. Okay, they're going in separate directions in a sense. And that's what's happening in these charts. That's why this is shooting up, because stock market cap is shooting upwards while GDP is remaining, somewhat stagnant. Okay. Divergence is huge. I cannot express enough how important divergence is. It's a very big deal within our stock markets, and we're going to dive into more of that. I do want to mention something. Everything in our markets is relative, okay? Relative this, relative that. That means that what happens today is relative today, right? Now, if we were looking at the stock market back in the 40s and we were looking at those GDP to stock market cap numbers, they wouldn't be relative, okay? So there is a little bit of a rolling window here with all this information. Please be aware that relativity is really important, all right? So one thing I want to mention here, that the average PS, and this is stock price to sales, was 14x, okay, in the S&P 500 just about 5 months ago. Since it has jumped to 17x in just 5 months. That's a huge move. Huge move. Again, getting away, up and away from that GDP. GDP is just kind of hanging out while everything is just getting inflated to dangerous levels from the stock market. Okay, and this move from 14 to 17 was entirely related to Fed dovishness. Really, no economic data that spurred that. Nothing, nothing at all. In fact, some global economic slowdown signals. What meanwhile we're at new all-time highs, purely off of Fed dovishness, off the fact that the Fed wants to cut rates. Let's talk more about divergence here. Okay, this is a really nice example of divergence. Okay, you'll notice right here, this green line is going to be the S&P 500. Okay, just a real basic chart of the S&P 500 over about the last 6 months. You'll notice the massive move to the upside. Meanwhile, this blue line is what we call earnings estimates. Okay, these are each, when a company has earnings, they come out and give an estimate for their next quarter. Notice that companies have devalued their earnings significantly over the last 6 months. Notice this divergence. So why would our S&P 500 be running at all-time highs while companies are actually, reporting weaker and weaker earnings over the last 6 months? Those are the types of questions you want to be asking. We call this divergence. One is moving to the upside, one is moving to the downside. Again, anytime you get major divergence like this, you have to start asking some serious questions. Okay? So again, that's divergence. One up, one down. All right. Let's talk real quick. This is like a quick little side note. I want to talk about the beige book real quick. The beige book, if you don't know what it is, Google it. You can go pull it up. Google Federal Reserve beige book, and it'll pull right up. They release this. What is it? 8 times a year? 1, 2, 3. Yeah, 8 times a year. They just released July's a couple weeks ago. Next one's in September. This is like a little snapshot into the domestic economy. Just want to point this out. This is a really nice little window into things we're getting. And the truth is, the economic data in the beige book was just very neutral, right? It was very flat, wasn't worrisome. Everything was, modest, slow growth, stable, modest growth. That's what everything said. Jobs, this and that. That's go read it yourself, what it said, okay? That's the type of data that does not warrant a rate cut, okay? It just doesn't. Does not warrant a rate cut. And again, that's where you start to ask some questions, okay? Rate cuts are kind of used as a stimulus in a lot of ways. All right, and again, we'll dive more into that. So what do we know currently? I want to talk about something super important. I want to talk about corporate debt. This is what we know about our current markets. Corporate debt is at an all-time high, and a very large portion of this money that's being lended to these companies is going towards something called this stock buyback. Now, if you're a shareholder, stock buyback is fine. It's a decent thing for you because it kind of reduces the share float and makes your stock a little bit more valuable. That's great. However, this money could be used in much better ways. A stock buyback in some ways is kind of a selfish thing for a company to do. It basically gives them a little bit more controlling interest in their stock, and it allows them to do certain things with their dividend that benefits them in a lot of ways. So a stock buyback, while on the surface it's good, it's not the best case scenario, and especially when those buybacks are being used on corporate debt. And we're going to talk about how we know that's the case. So companies are borrowing money to buy back their stock. Okay. Now, of course, cash is being used as well. Let's talk about this next point. The S&P 500 companies' cash levels have dropped by 15% just in the last year. This is a massive drop, biggest one since 1980. And this also coincides with a sharp increase in debt levels. So let's take a look at this next chart. This will make a little bit more sense. Okay, this is a trailing 12-month change in debt and cash. All right, so this chart's my next chart will be a little bit more clear, but you'll see this massive decrease in cash that companies are holding, meanwhile borrowing more money to the upside. Okay, you look at this and you say, oh, but debt's way low compared to this. This is a trailing 12-month change. So if we were to actually get a real look at corporate debt, it would be an upward move like this. Okay, but this is a trailing change, so it's a little bit deceiving. But I just want to point out what movement is debt making and what movement is cash making. What do we call that? It's divergence, and it's a big deal. Okay. All right, so let's talk. This chart's a little bit easier to read here. This, again, charge credit to where credit is given. Instead of me going and creating these myself and nitpicking over every single ounce of data and getting my charts just right, luckily I was able to find some ones that work really well. So just, again, credit to where credit is due. So I want to talk about this real quick here. Notice This orange line is overall leverage being used by companies. You can also appear in the 70 trillion area, okay? And we're at basically just massive levels that have never really been seen before, okay? This is total system leverage on really the entire economy as a whole. Pretty crazy levels, all right? And you'll notice that here's 2008 here. Notice the divergence. We get the massive pullback away here, and as we get this divergence, we get debt moving to the upside, and then meanwhile you have the S&P 500. This is more divergence leads to a significant crash. This is actually was divergence in the opposite way. Even divergence, any way you look at it, can be a negative thing, okay, if it gets too much and gets too extended. So just another example here of the massive amounts of leverage being used in our economy right now. All right, now what's the big deal about corporate debt? What's the big deal? Markets are at all-time highs. They're buying back stocks. Great. Well, with anytime you deal with debt, people were saying that same thing back in 2008. What's the big deal with this massive amount of leverage and these credit default swaps, et cetera, and with the housing instance? Well, the issue is one day this debt comes due. Okay. And of course, there's always a danger for something to default. When you hear the term default, you probably get taken back to 2008 things, and we don't want to get too technical, but just know there's obviously risk. Anytime debt are at high levels, the more debt, the more risk that is there, the more risk potential, okay? But there's more to this chart than meets the eye. Notice these three levels, okay? This gray line represents the federal funds rate, interest rate. Okay, you'll notice each time we have one of these lines, notice what's quickly followed. Credit to the Fed, they are able to foresee a recession, usually just by a little bit. Okay, you'll notice all of these lines will downturn just before the actual recession. The recession is highlighted in this kind of blue area. Credit to them, they really can see, some economic downturns and recessions. It really is actually pretty amazing. These are the last three recessions they have actually foresaw, not by a ton, but by a decent amount. So this is the federal funds rate. Okay, you see 3.6. Back before the housing crisis, we were at about the 5% level. .com, 7% or so, etc., etc. Now, what's the deal here? Okay, the deal is this. When the Fed decided to start easing rates because they foresaw an economic downturn, look how much room they had to cut. Okay, in the 90s, they had, 600 basis points worth of room to cut. More than that, 650 basis points worth of room to cut. And in 2000, they had 625 basis points worth of room to cut. In 2008, they had about 500 roughly room of basis cut. But look where we are. Okay, we do not have the room that was previously allowed. Okay, this is worrisome. Okay, yet here we are about to start another easing cycle starting tomorrow. Okay, about to start another easing cycle. We're gonna run out of room real quick. We do not have the room. If a recession does come, we do not have the room to bail ourselves out with these rate cuts. Okay, it's a major concern. So just to review, in 2001. The Fed cut rates by 525 basis points. In 2007, they cut it by 500 basis points. And this worked. To their credit, this worked. This helped stimulate our economy again and helped bring us out of these pretty nasty crashes. And yes, they were crashes. Well, guess what? Here we are in 2019. We're starting an easing cycle. But guess what? We have half the room that they did. And that would take us to a 0% interest rate environment. Okay? It's like you're, you have a pistol. And you have, the more bullets you have in it, obviously the more protection you have. Shoot zombies coming at you or whatever. But if you have 600 bullets for your pistol, you can last a lot longer, and there's a lot more room for error, and it can take some time for you to, I guess, be safe again. Well, in this case, you only have 225 bullets for your pistol, which is a decent amount. You'll be able to kill at least 225 zombies. But what if there's 226 zombies out there? Then what? You're going to have to go to alternative measures, okay? So that's a little bit concerning, the fact that we don't have the room that they previously did. So let's continue talking about interest rates. With them being aggressively cut, we are starting at lower levels than ever before, just like I talked about, gun with limited ammo, okay? We have to talk about yields. I don't want to get too technical, but the general idea with yields, a yield means basically the return that you can get on your money, okay? Through bonds, treasuries, T-notes, etc., okay? That's probably worth Googling if that doesn't make sense to you. You know, I'm sure you can find a YouTube video in about 10 seconds explaining a little bit more. But the general idea with yields is that people are having a hard time getting a decent return on their money. Okay, you know, they can't stash massive amounts of money in a super safe place where they can get a decent return on it. So what this leads to is people getting a little bit desperate. They have to take some riskier investments. Just like in 2008, those riskier investments were, you know, housing, the mortgages and credit swaps, et cetera, et cetera. So people get a little bit more aggressive as they look for a yield, okay? And this creates bubbles. People moving their money like this creates bubbles. It's dangerous, okay? It's just basic economics. A negative yield curve is dangerous. And a negative yield curve means that you can actually yield more on your money over the next month than you would on a potential yield that's, you know, 10 years down the road that has a longer expiration date. And again, okay, a little bit more complex. Go ahead, Google it if that's not clear to you. But just know that we're in a tough spot with yields right now, okay? And lowering interest rates does not help that. Okay, I just want to talk about this real quick. Charting the VIX. If you don't know what the VIX is, check out my other YouTube videos that talk about it. The VIX is basically the fear gauge in our markets. The higher it goes, the more fear there is in the markets. You can see, you know, back in February of what was that, 2017, VIX went from $8 to $50 in about, you know, 3-4 weeks. So this gauges fear in the markets. Well, people say that the VIX, it's not worth charting. There's no technicals on the VIX because of what it's derived in and what makes up the VIX and its movement. And there is some truth to that. But there's also some truth into these chart patterns and technical patterns. And I want to get a little bit more specific and talk about the VIX over about the last 6 to 8 months or so. Okay. Notice this is, so you can call this a descending triangle, but you can also call it a compression triangle. And I think a compression triangle actually paints the picture a little bit better. What I mean by compression triangle is you get these moves from the VIX and it just gets tighter and tighter and tighter, and it compresses and compresses and compresses, and it just gets so stinking tight. It's just like, you know, you're compressing water, just like an engine compresses gasoline and oxygen to create an explosion and combustion. It's a very similar process on the VIX, and you'll notice it's happened just recently in the last couple months, a pretty explosive move to the upside. Well, then we repeat the cycle. The VIX compresses, 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 and it's a similar move to the upside. It compresses so much to where we get an explosion to the upside. Okay, so I just want to point this out. The VIX, it is worth paying attention to. It definitely is. Okay, real quick, my expectations here. This is me really throwing it out on the line, and I kept it decently vague. Okay, but I want to talk about what my expectations are here. Okay, I'm anticipating between a 24 to 30% pullback off of all-time highs, with the potential to be as much as 35% if attempts at desperate rate cuts fall on deaf ears. And that would be a major recession. A 24% pullback in markets does not have to be a recession. It can be a correction. Remember when I talked about how every time the Warren Buffett indicator moves up and over 140, it tends to correct? That's all I'm looking for here. Okay, I'm not predicting that the end of the world's coming. I'm not some massive bear. I'm really not. I'm actually a major bull, and I'm going to actually explain the best possible thing to happen with this pullback. It presents incredible opportunity for us bulls. Okay, so I'm anticipating a 24 to 30% pullback off of all-time highs. Now, to give a little more insight to what I'm referring to here, this pullback in 2018 in December, it was a 24% pullback. Okay, from here to here. This was just a couple months ago. I'm looking for something somewhat similar to this. Okay, not trying to get crazy again, but that's what I'm looking for. I'm anticipating, you know, the potential for that 24% pullback. All right. Now, if we really break down and if we give up December's lows, okay, then there's going to be some major things to concern some major reasons for concern, because it would mean that a lot of different moving pieces are happening in the wrong direction. You do definitely want to see this level hold. This is the NASDAQ. This is the composite, about the $6,200 level on the composite. I would be pretty terrified, truthfully, if we do fall into this number. And Don't throw it out the window. Just know that it's a level to watch. But we can totally get a healthy pullback here from markets and still, not go into recession mode. Okay, I'm not anticipating that we for sure 100% are going to recession mode, but that 6,200 level is worrisome. I want to talk about a couple other charts here. And this video, honestly, I could have made it 10 hours long. I actually made and remade this about 8 times already. And I just got really frustrated to the point where I was like, I just need to get this out there. It's not coming off. It's not going to come off perfect. There's going to be tons of questions and things that I didn't cover that I would have wanted to be more clear and things. But this is it. I just needed to get it out and get, even though it's kind of a raw product. But some noteworthy charts here. This is the 3-year weekly chart on the composite. Remember that compression triangle we were talking about? Well, this is a upward compression triangle, which means it's likely we get a explosive move to the downside. Just like on the VIX, we were getting compression triangles and explosive moves to the upside. So this is an ascending wedge, an ascending triangle, whatever, compression triangle. There's a million different names for everything. The important thing is that you understand what it means. Way more important than knowing what that actual stinking name is. Okay, if we take a step back a little bit deeper, this is the S&P 500 over the last 10 years. Okay, you'll notice that volatility has become a major player at the beginning of 2017, and it's awesome that it has, because it creates incredible opportunities for us traders. Notice where we're really starting to top out here. I would also do this. This isn't going to be the most clear thing here, but you also notice that we're really, let me draw this real quick. We're really starting to get some rounding here and some action on a rollover. Kind of similar to this action. This is what we call a rollover. Very slow. Each break to new highs is a little bit slower than the last till finally you get a pullback. This, of course, wasn't a huge correction, but you get the kind of general idea. Had it have given up this level, then that's where a confirmed rollover would be. But anyways, you get the idea here. There's a lot of things lining up. Notice these trend lines, a move to potentially head back toward this area. This is that level that I was talking about was a major problem potentially. But just a very natural pullback area for the S&P when you add all the different moving pieces. Okay. I mentioned that this level is going to be a significant breakdown level. If you're like just really want to sit on the sideline, wait till it gives this most recent low up from just a couple months ago. You'll have plenty of downside to get in still if you want to be a little bit more conservative with this. Okay. So those are my thoughts there. So what is the best way to play this? Okay. Well, there's a couple different ways. Obviously, you can long volatility and long the VIX. I don't love the VIX, but it's going to be in play, no doubt. That's kind of your basic way. You can play it through TVIX, UVXY, etc., etc. In my opinion, after a lot of research, the best way to play this move is going to be shorting volatile tech names. Okay, tech is going to be and has been for a long time the most snappy sector in our markets. And when I say snappy, I just mean volatile. Okay, so if we can get a 10% pullback from markets, from the S&P or the composite, for certain equities, it can mean a much more significant pullback can be exaggerated significantly. And in my opinion, that's where the opportunity is going to lie. Now, to be even more specific, and this is a bold call out. Okay, again, I'm making bold moves. I'm being transparent as ever. This is a sector that's really concerning to me. The semiconductor sector. Many people call it the chips. I like to call them chippies because it rolls off the tongue. But this is a sector that's of major concern to me. And to be more specific, there's one specific name that I feel can really lead to some significant profits to the short side for us as all this starts to develop. So real quick, let's talk about why I want to short chippies. Remember how we've talked about divergence, we've talked about extension. This fits all of that perfectly, okay? Again, we've talked a ton about compression triangles, all in play here, these compression triangles, extension. I mean, this is just back in December. We're up a massive amount from $80. This is, sorry, to be more clear, this is an ETF that represents some semiconductors. This is SMH. This represents ETF that kind of takes an average of a bunch of different semiconductors and things like that. So this gives you an overall idea. The craziest thing is that people are claiming this to be oversold still. Okay, and anyone claiming that, you need to present a really strong thesis to me on that, because I've looked at it inside and out about every possible way, and I just don't see it, and I'll get more into why. But this has been bought up, had incredible bounce. Now notice that this breakout over the most recent high was, okay, that was a terribly not straight line. Was not terribly significant. This wasn't terribly explosive. Decent little breakout initially, but pull back right to that level. That's not the breakout you want to see over those recent highs. Okay, if you're bullish on semiconductors. To be more specific, let's talk about NVDA. Okay, this is the name that, in my opinion, is going to provide some really nice risk to reward opportunity to the downside for us. Okay. Here's the NVDA chart over the last year. You can see we're getting a pretty significant head and shoulders pattern forming. And this is, the stock is currently at about 173, and it is currently at a major sticky area. Okay, this is an area struggled with a lot. We have a very consistent pattern of recent bounces off of these areas, two similar bounce and retrace levels. We can talk about Fibonacci and get real crazy if we want. But just in general, we have a head and shoulders pattern forming here, and in conjunction with some other things that I'm going to talk about here, I really like this to break down for us. Okay, so to be totally clear, I am short NVDA. Okay, and I'm almost dead break even on my short right now. Okay, now to be a little bit more clear, here on NVDA, this is us right here. This is a 3-year weekly chart. If NVDA ends up giving the 125 area, just like I mentioned that area on markets, it can really get out of control. Sub 100 move is totally in the works. If 125 ends up giving up, would be just a major sentiment change. But that's my price target, though, is actually a little bit more conservative than that. But I do want to talk here about why I believe NVDA. This is just one of many reasons. I'm trying to be somewhat brief, but one of many reasons why NVDA is so appealing here is to look at price to sales ratios. Okay, this is other counterparts in a similar sector. ATVI, it's Activision, AMD. Just released earnings today. It was actually a miss. Negative year-over-year growth. Okay, INTC, same thing, negative year-over-year growth. INTC initially gapped up, went red just last week. AMD sold off, and originally like 12%, ended up closing after hours today down 4.5%. But look at the price to sales, the up and overextended price to sales ratio on NVDA. NVDA, even if this were to pull back and be even with some of its counterparts here, that would represent a massive pullback. We're talking 40 to 50% pullback in this name. Not saying that's going to be the case. Not saying this thing's going to crash and go to zero. Okay, again, I'm a bull at heart. I really am. But this concerns me. This, along with quite a few other reasons, concerns me. This is just one example I want to talk about here. I am short NVDA, and I'm expecting the divergence that we were seeing here in the stock price of NVDA in relation to some of its fundamental data, as well as the data from other names in this similar sector, tells me that NVDA is an extremely overextended name within the semiconductor sector. Okay, so just want to talk about NVDA. Really like it for a move to the short side, head and shoulders, lots of things happening there. Let's summarize real quick. I know this has been a massive ramble. Please, if you have questions, post them in the comments. I love questions. If you disagree, if you think I'm an idiot, go ahead, let me know. Please be respectful. That's all I ask. There's no tolerance for disrespect. But let's talk. I'd love to talk about different things. It'll be fun to see how this video matures. You know, if you're watching this 6 months from when I actually posted it, how do we do? Okay, where was I at? How do we do? Were some of the things that I feel I can currently foresee, were those accurate? And how can that make us better moving forward? If I was wrong, you know, where did I miss the boat? Those are all the things that we want to evaluate. But as a summary, markets have diverged in a just insane place away from GDP, taking it into extreme danger levels according to Warren Buffett's scale. Additionally, globally, the economy is slowing. All right, I didn't talk a ton about some of those numbers, but you know, looking in Europe and Asia and things like that, it's a massive global economy slowing. However, U.S. economic data is not terrible, like I mentioned in the beige book. Okay, so there's some divergence even there as well. S&P 500 earnings estimates versus the S&P 500 itself have diverged in an insane way. That was the first chart I showed you. Additionally, corporate debt and buybacks are at unsustainable levels. I talked specifically about the chipmaker sector and my thoughts on that level and how it can be a really nice move to the short side. Then I talked about the history of the VIX. It's not a super easy thing to chart, but it is worth noting, and don't hesitate to chart the VIX at times. Okay, talked about the negative yield curve, and we also talked about the super significant thing here that the Fed is preparing to cut rates for the first time in a long time, where just last October, not even a year ago, the Fed almost raised rates on almost identical domestic economic data. Okay, it's just crazy. In terms of China tariffs, I didn't even get into this. Okay, I mean, this is the headlines that we're seeing day in and day out. I didn't even mention this. Okay, if China goes bad, just throw, times everything I said by 3. Okay, I think we're years away from China tariffs. If Trump gets reelected, there's no reason for Trump to make a trade deal early. Drag this out. It doesn't matter. He's going to have massive leverage over China for those reasons. Of course, if he's not elected and we the color of the presidential seat changes, that then economic policy and things changes, so it will be a totally different story. But there's no reason for President Trump or China to make a deal right now. It's not happening. It's been going on for 18 months and it's probably going on for another 2-3 years in reality. Now let's talk about the other side of the argument. What is the bull thesis? And this is probably where I'm gonna get the most comments. People saying I didn't give this enough credit here, but we are getting rate cuts. A rate cut is a bullish thing for an economy for the most part, because it makes money cheap, gives you more confidence to borrow, spend, things like that. And additionally, we have some solid GDP numbers, domestic economic data, record high buybacks and stocks. These are good things, right? Okay, but don't those kind of counteract each other? Why are we cutting rates if domestic data is fine? Why are we cutting rates if jobs, inflation, home sales, jobless claims, CPI are like good, healthy, really healthy actually? There's just some catch up here. The truth is Trump beat Powell. He just did. He really did. Early in the year, absolutely destroyed Powell when Powell said he was going to raise rates last year. They've completely changed their stance. This is kind of an embarrassing thing, truthfully. It's just not making sense. It's just not. To cut rates where we currently are is concerning to me. To cut rates when we almost raised rates on the same data is concerning to me. If it doesn't make sense, if it looks like it doesn't make sense, it doesn't make sense. Okay, walks like a duck, talks like a duck, acts like a duck. It's a duck. So what to do in this whole process? Again, I'm not predicting a massive economic recession. I am predicting a healthy pullback, healthy little correction that could turn into a recession if things get really nasty. But just stay calm. There's no need to give up on capitalism and free markets, okay? But protect yourself. Make sure you are protected. Make sure you do have exposure in the right ways. And the best thing of all, I told you, I am a bull at heart. There's going to be some incredible dip buying opportunities that we just won't be able to get enough of with time if we can really be patient, okay? That's going to sum it up. I know that was a mess. I'm sorry I spent way too long making this movie. And like I said, I made it and remade it 100 different times. But this sums up some very critical data and some things to look out for moving forward. All right. If you have any questions, again, I welcome them. Please let me know. Would love to talk. We do have a free trial in our chat room, and certainly love welcoming people in to trade with us. So today was a great day. Had about 2,200 in profits today just on day trades alone. All right, that is it.